So what is an adjusting journal entry? An adjusting journal entry, it's a special type of journal entry. As we get farther in accounting, we're going to see special type journal entries. We've already heard of compound journal entries where we might have 2 or 3 debits and then 1 credit. But what an adjusting journal entry does is it brings an asset or a liability account, okay, to its proper balance. Especially since we're using the accrual basis of accounting now, which is made up of matching the revenue and expenses when they're earned. As you can see, that's the next piece, managing, recognizing revenue expenses when they're earned. It is made on the last day of the period. And then cash is never part of an AGE. There are 5 types of adjusted journal entries. For right now, because we're working with a service business, we are going to learn about prepaid assets and expenses. Okay, so now, if we were looking at this and we did cash basis, which is not recommended, right? But let's say we did. And it reads, on December 29th, the company pays $6,000 cash for insurance. If we're going to recognize cash basis as recognizing when cash is spent, what you would do is you would show that you purchased insurance by an expense and that you still paid with it with cash. But that's not a true indicator, and this will affect the financial statements. This is not a true indicator of when these expenses were used to make the revenue, and that is why cash basis is not recommended. So once we're examining a business transaction for the accrual method, which remember, that's matching revenue with expenses in the same period. We are going to look at this transaction a little differently. What you're going to do is, let's say we're in the month of December. In December, we have to journalize and post the transaction because prepaid insurance came in and cash went out. So in December, you will have a journal entry that says prepaid expenses debit for the $6,000 and cash will have been credited for the $6,000, and you will have put that in your ledger. And $6,000 has gone. Okay? Now, if you read further, it says the insurance is for the time period of January 1st through June 30th. And this is where the importance of the accrual method comes in. What you have to look at is a timeline. And let's draw a timeline like this. You as the accountant have to figure out how much is used during that period of time. January to June is how many months? Perfect. 6 months. Excellent. So, here's December. That's where we did it. Let's do this as January, February, March, April, May, June, and let's just stick July on there just for fun. So if you look at the timeline, in December, we spent the $6,000. And it's shown here. Shown here. Okay? Now, if we're going to use revenue versus matching expenses and saying, okay, we made, for example, $5,000 worth of sales, then we have to expense what helped us make this was, let's say we have a fleet of vehicles, for example, and we're a web services business and we're sending people out to other businesses to help with them with their computers. So if we're providing a company vehicle, then we have to expense out what it costs for that month to run the vehicle. So right now we're doing it for insurance. So if we're using $6,000 for 6 months of insurance, that's $1,000 worth of insurance it took to help make this $5,000 into sales. So what you can do is then you can expense this out over a 6-month period of time. So each month it's going to be $1,000 that we're going to have to adjust out. Okay? We're going to have to adjust. And if I could spell, that would be awesome. We are going to have to do an adjusting entry. So what is the adjusting entry going to look like when we close out the period ending January? You are going to expense out the $1,000 worth of insurance. Remember the normal balance of an expense account. So your journal entry is going to look like this. And then your asset, do we own as much insurance as we did before? No, we don't. We post it here. Now at the end of January, you as the accountant know that we only have $5,000 left. Now I want you to continue, think it through how you are going to complete the adjusting entry for February 28th. Since the second type of adjusting entry is again for an asset, and another asset that we use throughout the month and it depletes or we lose it, is supplies. So if you think of this, here's an example of supplies. Let's say you might have this at home in your fridge. Soda, the donut holes I bring. We have so many, we divide them out and then they're gone. So if you think about this in terms of office supplies or any type of supplies, you look at it as, you look at what you started out with, then you count and see what's not used, which means what's left. What must be done to correct the balance? Because really, when you have supplies, and you have the balance of supplies that are there, and you say that you have $500 on the 1st of January, then when you look and at January 31st, you only have $100 left. That's the balance. Then what do you have to do to get this down to the $500? Yes, you credited the $400. Because that'll bring it down to where it needs to be. Because $100 is all that's left. And then you say, okay, this is the small cost of doing business that we used all month. So the supplies expense would go here for $400. And there's your journal entry. And here, your balance for supplies is a debit balance of $400. Now you only have $100 left in supplies. Now I'm hoping a few of you noticed that there's a typo. And it is right here. It says on January 31st, you had 500. And then again on January 31st, you had 100. So please note, this is January 1st. I hope I didn't confuse anybody. It was done intentionally. I hope you caught it. See you in class.